Everyone in crypto sees JPM Coin and assumes the banks are coming to kill public ledgers. They see a $2 billion a day private blockchain and think competition. But the real story isn't about JPMorgan winning. It's about what happens when every major bank builds its own walled garden. More private ledgers doesn't mean less need for public settlement. It means more fragmentation, and fragmentation needs bridges. In the next 15 minutes, I'll show you why Kinexys is the best proof yet that neutral bridge assets aren't optional. They're inevitable. The misconception that misses the architecture. The dominant narrative in crypto frames JPM Coin as a direct competitor to public bridge assets. That's a category error. Comparing a private deposit token to a neutral settlement layer is like comparing a corporate intranet to the internet. They solve different problems at different scales, and the confusion between them leads people to exactly the wrong conclusion. JPM Coin isn't a stablecoin. It isn't a CBDC. It's a tokenized claim on deposits held at JPMorgan, issued on a permissioned blockchain, redeemable one-to-one in central bank money through normal banking channels. That means it carries the same credit risk as any JPMorgan deposit, and it lives entirely inside the regulatory perimeter of traditional banking. This matters because it defines what the token can and can't do. A JPM coin can move between JPMorgan accounts and approved institutional clients at near instant speed, 24 hours a day. But it can't settle natively on Citibank's ledger or on a public Ethereum smart contract or in a central bank wholesale system. It was never designed to do those things. And because a deposit token's value comes from its direct claim on a specific bank, it can't become a generic bridge without losing the very property that makes it acceptable to regulators and risk managers in the first place. So the real structural question isn't whether JPM Coin will replace public bridge assets. The real question is what happens when every global, systemically important bank builds its own Kinexys, because that's what's happening. Citi has token services. BIS Project Agora is exploring tokenized wholesale money across multiple central banks and commercial institutions. The trend isn't one bank coin to rule them all. The trend is every major bank issuing its own tokenized deposits on its own ledger, under its own legal framework, with its own permissioning rules. The tribal crypto war narrative persists because it's emotionally simple. One coin wins, another loses. But institutional finance doesn't work that way. Banks don't surrender their balance sheets to a competitor's token format. Regulators don't allow one jurisdiction's legal framework to override another's. So the future we're actually heading toward looks nothing like a winner-take-all battle. It looks like a map with dozens of efficient islands that can't talk to each other. And that fragmentation is where the real opportunity lives. What Kinexys actually built. To understand why private ledgers create demand for public bridges, you need to see what JPMorgan actually built. The story starts in 2019 with Onyx and JPM Coin, a tokenized dollar deposit for internal JPMorgan transfers. At first, it was a narrow experiment. Large corporate clients could move value between JPMorgan accounts on a permissioned chain instead of waiting for correspondent banking windows to open. That was useful, but it was contained. Then the platform expanded. Onyx Digital Assets launched as a separate network for tokenized securities and collateral. U.S. Treasury repos could be tokenized and moved intraday between counterparties for financing and collateral management. Markets Media reported that this network was processing up to $2 billion per day in tokenized repos and short-term financing. Bloomberg documented the first live blockchain collateral settlement involving BlackRock and Barclays, where tokenized shares of a money market fund moved as collateral in a derivatives transaction. The collateral moved intraday, which matters enormously in a market where funding costs change by the hour. This wasn't a pilot. This was production infrastructure handling real positions and real risk between major institutions. In late 2024, JPMorgan rebranded Onyx to Kinexys. That rebrand was a signal, not just a marketing move. Major banks don't rename and relaunch internal technology units unless they see a durable strategic opportunity and are prepared to allocate engineering resources at scale. Kinexys now sits as the brand wrapper for an evolving stack that covers payments, collateral, and digital asset networks. The name itself comes from kinetic, suggesting movement and velocity. That isn't the branding of a defensive experiment. It signals a platform they expect to grow. The recent moves are even more telling. In November 2025, JPMorgan launched JPM Coin on Base, which is Coinbase's Ethereum Layer 2. That marked the first time the bank's deposit token was issued on public blockchain infrastructure. In January 2026, Digital Asset and Kinexys announced plans to bring JPM Coin natively to the Canton network, a privacy-preserving public blockchain built specifically for regulated markets. Visa had already joined Canton as a super validator in March 2026. In March 2026, Mitsubishi announced it would use Kinexys for global corporate payments, and JPMorgan set a target of $10 billion in daily transaction volume. In December 2025, JPMorgan Asset Management launched MONI, a tokenized money market fund on Ethereum, giving qualified investors on-chain subscriptions to treasury exposure. Here's the pattern most people miss. From internal JPM Coin transfers in 2019 to $2 billion a day in tokenized repos, to Ethereum Layer 2 deployment, to privacy-preserving public networks, to global corporate adoption. Each step expanded the perimeter. Each step moved value further from JPMorgan's exclusive control and closer to shared infrastructure. The bank that built the biggest private ledger in institutional finance is now actively reaching outside its own walls. That isn't the behavior of an organization trying to replace public settlement layers. It's what you do when you recognize closed systems have natural limits, and that the next phase of growth requires connection rather than isolation. The walled garden multiplication problem. JPMorgan isn't alone, and that's the critical point. Citi Token Services went live commercially in 2024 for 24/7, cross-border liquidity between Citi branches and selected institutional clients. The Bank for International Settlements launched Project Agora to explore how tokenization can improve wholesale cross-border payments by integrating commercial and central bank money on shared or interoperable ledgers. The BIS 2023 survey of central banks found that more than 80% of respondents are working on CBDC-related projects, and many envisage them as interoperable with domestic payment systems. Multiple tiers of the financial system are converging on tokenization at the same time, but they're converging on parallel tracks rather than a single shared rail. Each of these systems is architected as a private, permission network. JPMorgan's deposit tokens settle on JPMorgan's infrastructure, with JPMorgan's KYC under JPMorgan's legal contracts. Citi's tokens settle on Citi's infrastructure, with Citi's compliance frameworks. The BIS project explores interoperability, but the starting assumption is that multiple currencies, multiple regulators, and multiple legal jurisdictions will need to coexist on connected but distinct ledgers. This creates what I call the walled garden multiplication problem. Every major bank that launches its own deposit token creates a new isolated liquidity pool. Each pool is efficient internally. Value moves fast inside JPMorgan's walls and fast inside Citi's walls, but the gap between those walls is where the friction lives. If you're a corporate treasurer with tokenized deposits at Bank A, and you need to settle with a counterparty whose deposits sit at Bank B, you can't simply transfer tokens across ledgers. The legal frameworks don't match. The permissioning rules don't match. The technical stacks don't match. So you fall back to the old plumbing. Correspondent banking relationships, Nostro and Vostro accounts, pre-funded accounts in foreign currencies that tie up capital for days. Settlement windows that only open during business hours in specific time zones. The very friction that deposit tokens were supposed to eliminate inside each bank's ecosystem gets recreated at the boundaries between banks. 10 major banks, each with their own incompatible ledger means 10 efficient islands surrounded by the same slow water that has always separated them. The technology inside each island improved dramatically. The ocean between them didn't. Which means the problem isn't that banks built ledgers. The problem is that they built ledgers that don't connect. This isn't a theoretical concern. JPMorgan's own deposit token white paper acknowledges that scalability and interoperability with existing banking systems are essential. The paper explicitly frames deposit tokens as an additional ledger layer that coordinates settlement between participants, not a wholesale replacement of legacy systems. Even the architects of these private networks recognize that the ledgers must connect to something else. And that brings us to the architecture question that the threat narrative never answers. If these walled gardens can't talk to each other, something has to bridge them. Why neutral bridges become mandatory? The architecture answer is straightforward. If Bank A's token only functions inside Bank A, and Bank B's token stays inside Bank B, then value moving between them requires an intermediary that both banks can accept. That intermediary needs to be legally neutral, technically compatible with multiple ledgers, and trusted by counterparties who may be competitors in every other context. This is where the architecture becomes clear. Public bridge assets and cross-chain liquidity protocols aren't replacements for bank money. They're connectors between incompatible pools of bank money. Think of it as plumbing. If you have two pipes that don't connect, you need a junction. The junction doesn't replace the pipes, and the pipes don't depend on the junction for their internal function. But without the junction, water can't flow between the two systems, and the overall network remains incomplete. It makes the system work as a whole. The Monetary Authority of Singapore understood this early. Project Guardian, led by MAS, brought together JPMorgan and other institutions to test how tokenized deposits and tokenized government securities could trade using DeFi-style protocols on a public blockchain. In November 2022, JPMorgan executed its first live DeFi trade on Polygon as part of this pilot. Tokenized cash deposits and tokenized Singapore government securities were swapped using automated market maker logic in a permissioned environment that ran on top of a public chain. The experiment worked because the public chain provided the neutral infrastructure where assets from different issuers could interact, while the permissioning layer handled the compliance and identity controls that institutions require. That's the model. Private bank money stays private, regulated, and permissioned. But when it needs to move beyond its native ledger, it does so through a neutral shared layer that no single bank controls. The more banks that tokenize their deposits, the larger the design space for these bridge protocols. Every additional walled garden multiplies the number of potential connections, and each connection increases the utility of the neutral layer that enables it. This is the opposite of a competitive zero-sum game. It's a network effect where the value of the connector rises precisely because the number of disconnected nodes is growing. That's why the threat framing collapses under its own weight. A single private ledger might look like competition, but 100 private ledgers, each with its own rules and boundaries, create a fragmentation problem that only neutral infrastructure can solve. The banks aren't building an alternative to public settlement layers. They're building the exact conditions that make public settlement layers indispensable. The structural argument is strong, but the empirical evidence from the last 18 months is even stronger. The evidence is in the pilots. The trajectory from private to public isn't speculation. It's already visible in what JPMorgan has put into production. In May 2025, JPMorgan completed its first transaction settlement on a public ledger outside its private system entirely. That was a landmark. The bank that built the most successful private blockchain in finance explicitly chose to settle value on public infrastructure. Then came JPM Coin Base in November 2025, a bank-issued deposit token backed one-to-one by JPMorgan deposits, running on an Ethereum Layer 2. That isn't an internal experiment. That's a production deployment on public blockchain rails, available to institutional clients for near-instant, low-cost settlement. It demonstrates that JPMorgan sees value in making its token accessible beyond the walls of its own ledger. The Canton network, move in January 2026, goes further. Canton is a public blockchain designed specifically for regulated markets, with privacy-preserving architecture that lets institutions share data selectively without exposing sensitive information to the entire network. By planning native issuance of JPM Coin on Canton, JPMorgan is signaling that it wants its deposit token to exist in an environment where other banks, asset managers, and infrastructure providers can interact with it on shared rails. Visa's decision to become a super validator on Canton in March 2026 reinforces that this network is becoming a genuine institutional settlement layer, not a retail crypto playground. The American Banker reported in March 2026 that JPMorgan Chase, Invesco, and other digital asset leaders are increasingly open to working with public blockchains like Solana alongside their private, permissioned ledgers. Banks aren't choosing between private and public. They're building both, which means they need what connects them. JPMorgan's own research acknowledges that stablecoin demand is growing for payments, even if crypto trading remains the primary driver. The language has shifted from skepticism to integration. Every one of these moves points in the same direction. Isolated private ledgers were the starting point. Ethereum Layer 2s were the next step. Privacy-preserving public networks are the next. The end state is a multi-ledger world where bank-issued tokens, central bank money, and public bridge assets all coexist. You don't move your deposit token to a public network unless you're convinced that network has a future. And you don't reach that conviction unless you expect other institutions to meet you there. In that world, the institutions that built the biggest private ledgers are the ones creating the strongest case for the neutral infrastructure that links them. Conclusion: Kinexys proves that the largest regulated institutions are committing real balance sheet and engineering resources to tokenized settlement. Every new walled garden adds friction, and that friction creates demand for neutral bridges. This isn't about picking winners. It's about understanding the architecture. The signal is validation. If this kind of structural analysis is useful, subscribe. This channel is built for exactly this type of research, and the next video goes deeper on settlement finality.